Geopolitical ripples aside, US Treasury yields just keep on pumping higher. Goldman Sachs stuck its neck out earlier this year and said we'd be at 2.5% on the 10-year yields by the end of 2013. We're now closer to 2.8, and the Fed is doing nothing to talk yields down. When do we go through 3, and what does that mean for bunds and gilts? Here to discuss all this with me, I'm pleased to say, is Francesco Garzarelli from Goldman Sachs, just around the corner from us. Francesco, what we've seen in Treasury yields so far has been pretty much beyond anyone's expectations. People are kind of going back to the drawing board and ripping up their forecasts. Do you think the yields we have now are reasonable for the data that we've seen?
Yeah, I mean, I would say as a premise, we have, I wouldn't say ripped our forecast, but we've changed them as the sell-off extended. And we have the end-year forecast at 275 and the first quarter of 14 at 3%. So we've been part of that process of upward revisions. I think that is fully consistent with the data. As you may recall, we were very bearish on bonds at the beginning of the year and into the sell-off. And I think, at the margin, talking about the data, we've had positive surprises out of Europe, of all places, and that has helped, yes. And I think that has helped build confidence on the recovery and put pressures on bond yields. Last but not least, we tend to think about these things in changes, but we shouldn't be forgetting that we're talking about 2.5% nominal yield for the next 10 years, with most central banks having a 2% inflation target. So that's 50 basis points only of real return over a 10-year average, which is pretty low.
Do you think the Fed is comfortable with where yields are now? I mean, the Bank of England, for example, has taken every opportunity to talk down the market where it thinks there are inconsistencies, but the Fed in recent FOMC minutes, for example, has made no such effort. Do you think it's comfortable?
I think it was uncomfortable with 1.6, which we touched in April. I thought that was a level that wasn't justified at all by the data, and gave you the impression that something in the form of a bond bubble was brewing. So the sell-off, I think, was welcome. Around 2.5, 275, as I said, are levels that we find consistent with the macro outlook based on historical relationships between yields and macro variables. I think the Fed may be a bit concerned about the volatility of yields. As you know, they keep on flapping around at the 5-year and the 10-year point. And I think that is partly related to where they stand on policy.
Is September tapering a done deal? I mean, we're very close to this taper monster that everyone's been talking about for months.
We think so. They've communicated that number of times that they're looking to change the mix. So continue to keep guidance at the front end of the curve and let the back end of the curve move in line with macro fundamentals. The neat thing here is that we find that macro fundamentals and bond yields now interact a lot, both ways, I would say. So stronger data, bond yields go up; weaker data, they go down, not as much, but they still go down. So that, I think, is healthy and welcome. And I think, to my point about policy, what the Fed can do here is really try to diminish the policy uncertainty. Yeah. And that is of two forms. One is the tapering, how they do it and over what time horizon. And secondly, who's going to take over from Bernanke when he's out?
Exactly. Just one last question on what this all means for the BOE. I mean, as we've mentioned, they've been uncomfortable with market pricing recently. Is the move in Treasury yields making life more difficult, effectively, for the Bank of England?
Look, here you have an economy that runs very much on variable rates. So I think at the end of the day, when we go home and think about our mortgage payments, we'll be looking at where the mortgage overnight rate sets.
So it's not market rates so much as real life rates that matter.
And I think that the whole Carney approach, really reaching out beyond the financial industry into the real economy, is evidence of that. Now, the gilt market is very sensitive, being the UK a small open economy, to international swings in interest rates. So if Treasury yields continue to go up, gilts are going to follow.
Yeah, they're going to get dragged with them. Listen, thanks very much for your time.
Pleasure.
Thank you.
Thank you for having me.